Imagine you wake up tomorrow and you are the owner of a $1 billion deepwater drill ship. Not an oil company, not a government, just you, standing on the bridge of a floating megastructure the size of 3 football fields, parked 70 miles off the coast in 3,000 feet of open ocean. On paper, you are sitting on the ultimate money printer. Every single second that giant drill bit turns beneath the ocean floor, you are charging an oil giant like Shell or Chevron roughly $7. That is $450,000 every single day, or about $160 million a year, just for floating in place and drilling a hole in the dirt. But here is the strange part. Even though you are sitting on an asset that prints cash faster than a mid-sized bank, the company that built your ship probably went bankrupt twice in the last decade. And right now, you are one bad storm, one mechanical failure, or one bad contract away from losing $20 million in a single month. By the end of this video, you will know exactly how that is possible, how the hidden financial machine behind deepwater offshore drilling actually works, why charging 6-figure daily rates still leaves owners hanging by a thread, and how an asset that costs $1 billion to build can become completely worthless overnight. To understand how the money flows, you first have to realize that deepwater drill ships are not just big boats. They are basically floating, self-powered industrial cities, built to operate in some of the most hostile environments on Earth. And they come in a few different tiers, which are completely different businesses. On the lower end, you have jackup rigs for shallow water, which cost around $150 to $200 million to build and lease out for maybe $100,000 a day. In the middle, you have semi-submersibles, which float on giant submerged pontoons for rough, deep waters and cost around $400 million. But at the very top of the food chain is what you own, a 7th-generation ultra-deepwater drill ship. Building one of these monstrosities takes about 3 to 4 years in a specialized shipyard in South Korea or Singapore. The baseline sticker price to get it out of the shipyard is around $600 million. But by the time you install the dynamic positioning thrusters that keep the ship locked over a GPS coordinate within inches, the dual derrick drilling towers, the blowout preventer that weighs as much as a Boeing 747, and all the specialized subsea equipment, your total capital expenditure hits anywhere from $800 million to $1.2 billion. Most owners do not have $1 billion sitting in a checking account. So you finance it. You put down maybe 20 or 30% in cash and borrow the rest through high-yield maritime bonds at 6 to 8% interest. That means before you even hire a single crew member or buy a gallon of diesel, your debt service alone is taking $30 to $40 million out of your pocket every single year. So how do you actually make that money back? This is where the core revenue model comes in, and it all revolves around one number: the day rate. Look, oil companies almost never own these ships. Exploring for oil miles beneath the ocean floor is insanely risky. So oil majors prefer to outsource the physical drilling to contractors like Transocean, Valaris, or Noble. You rent the ship to them on a fixed-term contract, usually for 1 to 3 years. In booming energy markets, when oil is over $80 a barrel, oil companies scramble for these ships, and day rates can surge to $600,000 or even $700,000 a day. In a moderate market, let us say you secure a 3-year contract at $450,000 a day. At a standard 90% operational efficiency rate, meaning the ship is actively working 328 days a year, your gross annual revenue sits right at $148 million. On the surface, that sounds like an absolute gold mine. If you hold that contract for 3 years, you pull in nearly $450 million in gross revenue. You might think you are halfway to paying off the ship, but here's the thing. Running an ultra-deepwater drillship is like burning money in a high-efficiency furnace just to keep the lights on. The operating expenses, or OPEX, are staggering, and every single day you are at sea, money is pouring out of your bank account in dozens of different directions. Your biggest daily expense is not even the ship itself. It is the human capital and logistics required to keep it alive. A modern drill ship carries a rotating crew of about 150 to 200 people. Marine captains, subsea engineers, roughnecks, crane operators, and hyper-specialized drilling technicians. Because they are working 12-hour shifts in the middle of nowhere for weeks at a time, you have to pay top-tier offshore premiums. Your labor costs alone run about $40,000 to $50,000 every single day. Then comes the supply chain. You cannot just drive to a gas station or a grocery store. You are operating an island. You need a continuous pipeline of specialized supply vessels running from mainland ports to your ship, carrying drill pipes, heavy drilling mud, fresh water, food, and spare parts. You also need dedicated helicopter charters running back and forth to rotate crews every 2 weeks. Helicopter transport alone can run $10,000 per flight hour. Add in constant marine insurance, catering contractors to feed 200 hungry workers 4 gourmet meals a day, subsea maintenance and dynamic positioning fuel, and your daily operating cost hovers right around $150,000 a day. When you do the math on a $450,000 day rate, your operating profit is $300,000 a day. Across a full year, that leaves you with about $98 million in operating cash flow. Subtract your $40 million in debt payments and another $10 million for depreciation and corporate overhead, and your net profit before taxes sits at roughly $48 million a year. That is a solid 32% profit margin. On paper, your net yield on that initial billion-dollar investment is sitting around 5 to 6%, which expands significantly as you pay down the debt. But here is where things get really wild. What happens when the drill bit is actually spinning miles below the sea? You see, the revenues do not just come from a simple flat rate. There are performance bonuses and brutal penalty clauses written into these contracts. If your rig operates with 0 downtime and hits drilling depth targets ahead of schedule, oil giants will pay you performance bonuses that can add another $50,000 a day to your intake. That sounds incredible, right? But the inverse is a nightmare. If your machinery breaks down, say your blowout preventer suffers a hydraulic seal failure 12,000 feet underwater, the clock starts ticking against you. In the offshore world, this is called zero-rate downtime. The moment your ship stops drilling due to mechanical failure, your $450,000 daily revenue drops to exactly $0 per day. But your $150,000 in daily operating costs remain completely unchanged. If it takes your engineering team 5 days to pull that 200-ton blowout preventer back to the surface, repair it, and lower it back down, you have not just lost $2 million in gross revenue, you have actively spent $750,000 out of pocket while making nothing. A single major equipment failure can wipe out an entire quarter's net profits in less than a week. Now, let us zoom out to the broader economy, because even if your ship runs like a Swiss watch, you are still bound to the chaotic cycles of the global oil market. So why do these offshore companies go bankrupt so often? Why did nearly every major offshore drilling contractor file for Chapter 11 bankruptcy between 2016 and 2021? It comes down to a brutal concept unique to heavy industrial marine assets: the fatal flaw of fixed overhead versus cyclical demand. A drill ship is not like a factory that you can just padlock and walk away from when business is slow. If oil prices crash to $30 a barrel, oil companies immediately cancel or stall offshore exploration projects because deepwater oil is expensive to extract. Suddenly, nobody wants to hire your ship. Your 3-year contract ends and there are 0 new tenders on the market. When that happens, you face a terrifying financial choice, and both options are terrible. Option 1 is called warm stacking. You park the drill ship near a coastline, keep a skeletal marine crew on board, run the generators, and maintain the machinery so the ship can be ready for work on 30 days' notice. Warm stacking costs you roughly $30,000 to $40,000 every single day. You are burning over $1 million a month on an asset generating $0 in revenue. If the market downturn lasts for years, you are forced into option 2, cold stacking. You turn off the engines, discharge the entire crew, seal the electronics in specialized dehumidified pods, and anchor the ship in a fjord or bay alongside a dozen other ghost ships. Cold stacking drops your daily bleed to about $5,000 to $10,000 a day for security and basic marine maintenance. Here is the catch. Cold stacking can permanently damage high-tech machinery. Subsea equipment degrades, marine growth covers the hull, and electronics deteriorate in the harsh marine environment. Reactivating a cold-stacked drill ship after 3 years of inactivity isn't a simple maintenance job. It can require tens of millions of dollars to bring the vessel back into service and complete inspections, repairs, and safety certifications. And if you don't have that capital available when the market finally recovers, your billion-dollar drill ship can become an extremely expensive liability, potentially worth only a fraction of its original cost. Think about the psychology of this for a moment. You built a machine designed to withstand hurricane-force winds and monstrous ocean waves, yet its financial value can be destroyed by an invisible chart on a Wall Street trading floor. When oil prices collapsed in the mid-2010s, drill ships that had cost hundreds of millions of dollars to build were sometimes sold for a tiny fraction of their original value, while others were retired or sent for recycling. Entire fleets of floating technological marvels became economically obsolete, not necessarily because they stopped functioning, but because the underlying economics of offshore drilling had changed. And this brings us to the ultimate secret of the industry. The smartest operators don't think of these vessels simply as ships or oil industry assets. They think of them as capital-intensive assets whose value depends on timing, utilization, financing, and the drilling cycle. The real opportunity isn't always in owning a drill ship for 30 years. Sometimes it's in buying the right asset at the bottom of the cycle and selling or contracting it when demand returns. Look at how private equity firms and distressed asset investors can approach the market. They wait for the bottom of the cycle, when oil prices are weak, drilling contractors are carrying heavy debt, and bankruptcy proceedings can force valuable assets onto the market. Then they can step in and acquire modern cold-stacked drill ships for a fraction of their original construction cost, potentially tens of millions of dollars instead of hundreds of millions, with little or no legacy debt attached. They do not care that the ship is idle right now. They have the balance sheet to pay the $5,000 a day to keep it parked in a fjord for 2 or 3 years. Then, as global energy demand rebounds and oil prices climb back above $70 a barrel, offshore exploration roars back to life. Oil majors come knocking, looking for deepwater rigs. But no new ships are being built because shipyards take 4 years to build them. Supply is capped, demand surges, and day rates shoot back up from $200,000 to $500,000 a day. At that exact moment, the private equity firm spends $40 million to reactivate the ship. Suddenly, they are running a top-tier asset with zero debt service. At a $500,000 day rate, their operational cash flow is nearly $350,000 every single day. Within 6 to 8 months of operation, they have completely recovered their initial purchase price and reactivation cost. Everything after that is pure, unadulterated profit. Once the asset reaches peak valuation, they sell the ship to a public drilling contractor for $300 million, pulling off a 600% return on capital in a matter of 3 years. When you peel back the layers, owning a $1 billion deepwater drillship is not really about drilling holes or pumping crude oil. It is a high-stakes, multi-million-dollar game of financial poker played against global commodity cycles, debt maturity dates, and operational risk. You are managing an engineering marvel that can drill through 7 miles of ocean crust, but your survival depends entirely on keeping that daily revenue counter spinning at $7 a second while ensuring the cycle doesn't run you over before you pay off the shipyard.